Hi, everyone, and welcome to our DAT weekly market update. I know it's hard to believe, but this is our update for July 1st, 2020. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by the intrepid Ned Damon, Principal Data Scientist at DAT.
Intrepid.
Second week in a row with no guest, Ned. Should we take a hint?
We don't have a guest, but we have something better than a guest. We have family, DAT family. We have Dean Croke with us this week, and I'll be excited to hear what he has to say. Do we have anybody else lined up, though?
Yeah, for sure. So we're really excited. July's going to be an exciting month. Next week, we will have Nadia Duke-Boone, who's the head of product at DAT, to talk about the new DAT One mobile app launch and what that means for carriers. And then later this month, we will have Claude Pamilia, who's president and CEO of DAT Solutions. Claude's going to join us to talk about market conditions, COVID, leading through turbulent times, and he'll actually be answering some of the questions by our viewers. And Ned will tell you later in the video how to submit those questions for Claude to answer. Ned, key points of the week?
Well, there's actually a fair amount of exciting stuff going on this week. The MCI map is heating up as shippers are anticipating higher demand from reopening states. There's a little bit of a crossroads in the trucking industry right now, pardon the pun. COVID-19 outbreaks kind of re-outbreaking, and inconsistent state reopening and expiring PPP loans mean that there's a lot of headwinds potentially, but there's also been a fair amount of tailwinds. So you know what happens when that happens, there's a hurricane. Finally, our forecast models all are pointing to, as they have been, a cooling off post July 4th as seasonal patterns reassert themselves. But we'll see that when we get to the forecasts. Ken, you ready for some market dynamics?
For sure. Thanks, Ned. We're going to get right into it this week and look at dry van load to truck ratios. This week, as we've talked about in weeks prior leading up to it, is typically the busiest week in the first half of the year, kind of right at the end of the first half. And we're seeing that. If you look at the red line, which is 2020, it sits just below 2017 levels, but considerably behind where we were in 2018. Looking ahead, just a couple short weeks, what we would expect is things to cool back down post July 4th holiday. But given these times and so much uncertainty, we're going to be closely watching it because it wouldn't be that crazy to see behavior out of the normal. Turning to reefers, this can be a little bit more unpredictable just given that growing seasons and harvest schedules aren't always running exactly as anticipated, but we're seeing similar seasonal trends. 2 strong weeks of upticks, and again, whether next week or the week after either flattens out or continues upward or contracts back down remains to be seen. But we at least see a couple more weeks of strength before the cooling off into mid to late July. We have an interesting chart here for flatbeds. I don't know that we've shown this one before, and I don't want to spoil the surprise, but this one sort of tees up our askIQ question later in the video. But what we see is since about week 15, it's been a pretty linear upward clip for flatbed load to truck ratios, sitting right between where they were in 2019 and 2017 at the moment. So something interesting to watch. I'm going to look at dry van MCI really quick. The one thing that's really interesting to note, you're still seeing these very bright areas of pronounced red, but if you look in the deep south, those are areas, if you look in prior videos or prior MCI charts, were deep red. That kind of the center of that strength is moving north and almost creating like a shelf along the Gulf of Mexico. So that's going to be interesting to see how it plays out. Across all of the MCI charts, we're still seeing strength, but you're starting to see signs of the momentum coming out of the market a bit as we reach our peak and then crest over. Looking at reefers, very similar thing. You're not seeing as much dense red, but you're seeing more areas of the bright pink, even fading off into yellow a bit. Moving to flatbed, this is interesting. I don't know that we've ever showed this one before, but you're just seeing crazy amount of red. Ned mentioned earlier, we have Dean on to help us a little bit explain what's going on here, but I wanted to tee it up with this chart that shows the Pacific Northwest, the American Southeast, really showing strength in the flatbed market. Spot rate trends, diving right in, dry van. We're not seeing much of a let up in the momentum here. What we see is rates above the March COVID restocking peak. They're starting to appear like the peak is coming and we're going to crest over, but we've been surprised before. I mentioned we're above the pre-COVID levels, but we're actually pushing up a point. If you look at right around $1.75, that would put us at basically total year 2019 highs. So if we push much more above $1.75, we'll be at a point higher than we were all of last year, not just same time last year. On the reefer side, it's been more of a slow and steady. We have seen it pick up in the last week or so. And we talked about in the video last week, are we just peaking a little bit early? Is it going to be an early peak plateau in fall? Or will it peak early and contract back down in a similar pattern? I think it's a little too early to tell what's going to happen there, but Ned will give us some insight when he talks about the models. On the zoom in chart, again, what you see is we put a little distance between ourselves this year and 2019, but still a much slower pace than dry van. Continuing the trend, we see flatbeds. Now, flatbeds didn't see the huge restocking push in March. They only really experienced the collapse in April and early May. But since then, it's been on quite a linear tear, kind of sitting right now just below 2019 and 2017 levels. And I think this next chart, the year-over-year view compared to 2019, shows that really well. Now, the interesting thing here is 2019, the second half of the year, things slowed down considerably, leading all the way into the last couple of weeks of the year. It'll be interesting to see how the tail half of 2020 plays out. Luckily, we have a forecast model and a suite of forecasting models that'll help us take a look at that. And for that, I'll turn it over to Ned.
Thanks, Ken. So you can see we're going to be moving to our dry van forecast. You can see in blue our actual freight rates observed by DAT. And then off to the right, you can see our 4 forecast models. In green is our ratecast model, which is our flagship model. In red, you can see our short-term model. And then in yellow and gray, you can see our 2 blended forecasts, which are mixtures of the ratecast and the short-term model in different amounts and in different ways. The ratecast models have been expecting for the last couple of weeks there to be a peak coming on July 4th and then things to trend down as normal seasonality reasserts themselves. To the extent that you believe that normal seasonality is going to reassert themselves, the ratecast models are a good guide to what you expect to be happening, whereas the short-term model is continuing that sort of bullish upwards trend. I'll be excited to see what actually happens. Moving forward to the reefer models, again, in blue are the actual rates observed by DAT, and then the model suite off to the right. Ratecast is expecting there to be things to be level up through July 4th, and then there to be a drop off heading into a plateau at around $1.85, it looks like, if I can read my chart properly. Whereas the short-term model is expecting continued up and to the right behavior. Here, I strongly believe that the ratecast model is the one that's going to be more accurately describing what's going on due to the much more seasonally tied nature of reefer rates. But I'll be interested to see what's happening with that as well. And finally, we move to our flatbed model. A similar story where the ratecast model expects that things have peaked and are going to kind of slowly make their way down to a plateau at about $1.85, while the short-term models are expecting the rip tear up and to the right to just keep going. But I think we have somebody who's got some really interesting information to share about that. And that ties into our askIQ question of the week, which is, what's causing the flatbed market to be so hot now? So, Dean, what's going on in the flatbed market?
Yeah, thanks, Ned. For the last few months, it's been a fascinating rollercoaster ride in the freight market. We've certainly seen some unprecedented data points. And since early April, when rates bottomed out for most equipment types, we've seen a steady increase in both spot rates and load posts. But what's interesting is that flatbed rates and load volumes have been growing at a 25% higher rate compared to both reefer and dry van. So it got me thinking about why that's going on. Now, what we're seeing in the flatbed sector in particular is a tightening of capacity in the last little while. This is supported by carriers and owner-operators that we've talked to over the last week. They're seeing things pick up considerably, which seems a little counterintuitive given industrial production numbers in May in the manufacturing, mining and utilities sector were about 15% lower than this time last year. But most importantly, May numbers were up about 1.4% for industrial production, which leads us to increasing demand for flatbeds. In the last week, load posts were up about 9% week over week, which is another positive sign. They're also up about 15% year over year. So while trucks searching for loads were down about 19% year over year, we take this as a sign that capacity continues to tighten, which explains the upward pressure on spot rates that we've been seeing for the last few days. In fact, when we look back at spot rates, Ned, since early May, when national average flatbed rates bottomed out at $1.60 a mile, they've been climbing consistently for 62 days straight now to reach $1.73 per mile this week, which is right around where they were in 2017 and 19, as Ken was explaining. Now, of course, flatbeds can haul the widest variety of freight of all equipment types. Just today, a friend of mine unloaded lumber from Canada in Atlanta yesterday, and he's now up in Baltimore loading machinery on his drop deck. So they're a versatile piece of equipment. But what's driving a lot of the flatbed activity, in particular on the flatbed and drop deck market, is this unseasonal and early demand in the building industry. And it's driving demand in particular for pressure-treated lumber, where there's a current shortage of supply. So as you know, Ned, pressure-treated lumber is used in the construction, landscaping, and home improvement sectors, which is where flatbed carriers have benefited the most in recent weeks. And here's why. During the COVID-19 shutdown, many homeowners had more time to work on home improvement projects, and this created the unseasonal and early demand for building materials, which are typically stockpiled in late winter and early spring.
Yeah, no, a lot of my friends have been working on a lot of home improvement projects. I have one friend who's building raised beds and a retaining wall, and I've been working on a fence in my backyard, and all of those use pressure-treated lumber.
Both my sons are back from college, and they've been working over the summer, and all they've been doing is building outside decks for locals here in New England. So of course, a lot of the home improvements outside the house, Ned, involve pressure-treated lumber for things like decks. Deck materials, interestingly, the majority of deck materials are sold between April and August. So when the summer inventory stockpile was drawn down earlier than expected because of COVID, there was an increased demand in home improvements during the lockdown as more people were outside building. And this has meant that lumber mills, carriers, and distributors of pressure-treated lumber and lumber in general are now scrambling to catch up. So the other thing that exacerbated the current lumber shortage in the industry here in the US was pandemic-related shutdowns at mills. Workers were in lockdown, and of those that stayed open, they reported reduced staffing levels and production as a result. So as Ken showed on this week's market flatbed index and market condition index map, we see the tight capacity and increased load volumes in the top lumber producing states, which include Oregon, Washington, Georgia, Alabama, California, Arkansas, Mississippi, North Carolina, and Texas. All these states are bright red on our market condition index this week. And these states produce around 30% of our flatbed volume over the course of a year. Now, on our MCI, you'll also see up into British Columbia and Alberta, you'll see those heating up this week. That's where a lot of flatbed volumes come out of. 75% of Canada's softwood production is located in British Columbia and Alberta. And about half of that volume gets shipped to the United States, which reminds me, we need to wish all of our DAT customers happy Canada Day today and hope they have a worthwhile celebration. So Ned, just wrapping up for the moment, flatbed carriers in the building industry, for those hauling materials that are related to building and construction, they're doing much better with rates. The rates are reaching about $2 a mile, probably up into the $2.20 a mile range at the high end for that specific commodity. Now, that represents about a 16% or 30 cents per mile increase in rates over the last 8 weeks, placing them well above the national average for all flatbed commodities, which sit at about $1.73 at the mile per this week.
Thanks, Dean. That kind of micro-targeted analysis, I think, is really helpful to carriers, flatbed carriers in particular, and knowing that their flatbed is just so heterogeneous from a modeling perspective that being able to do that kind of micro-targeted analysis on specific commodities and specific structures, I think, is really helpful and gives people a lot of insight. So I want to remind people to please do subscribe to our YouTube channel or wherever you get this particular content from. We're a new show and we'd like to grow and we'd like more people to hear excellent analysis like what Dean's providing. If you want to ask questions to us or to Claude, you can email us at askIQ@dat.com. We're also going to be offering our top 50 lanes report for free. So that is the top 50 spot lanes, both short-term historicals and short-term forecasts. And you can get that by emailing us at askIQ@dat.com. I want to thank everybody for joining us this week. And if you would like a more textual version of this update, you can go to dat.com/COVID-19. And there's more or less the same analysis, but in a web page. We'll be back next week with a new update, and I want to hope everybody has a happy Canada Day and or a happy 4th of July.